What is capital gains tax in farm succession planning? Imagine passing down your farm to the next generation and wondering how taxes might affect that transfer. Understanding capital gains tax can help you keep more of your farm's value intact. When you sell or transfer from assets like land, buildings, or equipment that have increased in value, the profit is called a capital gain. This gain is subject to tax unless specific strategies are used to reduce or delay it. In farm succession planning, managing this tax is key to keeping the farm within the family without having to sell parts of it to pay taxes. The amount of the gain is the difference between what you paid for the asset originally and what it's worth now. For example, if you bought farmland many years ago for a low price and it's now worth a lot more, the increase in value is the capital gain. When you transfer the farm during your lifetime or after death, this gain can trigger a tax bill. A very helpful tool in farm succession planning is the stepped-up basis. When you pass away, the farm's basis is reset to its current market value. This means your heirs inherit the farm with a new basis equal to what it's worth at that time. If they sell the farm immediately, they won't owe capital gains tax on the appreciation that happened during your lifetime. This provision helps families avoid large tax bills and makes it easier to keep the farm in the family. Transferring from assets as gifts during your life can also trigger capital gains tax. The recipient's basis is usually the same as yours, so if the farm has appreciated a lot, they could face a big tax bill if they sell it later. Some tax reliefs or deferrals might be available, but careful planning is necessary to avoid surprises. How you own the farm also matters. If you own it as a sole proprietor, partnership, or limited liability company, the way capital gains are taxed can differ. For example, pass-through entities like partnerships or limited liability companies report gains directly on owners' tax returns. Corporations might face double taxation, which can complicate succession plans. Choosing the right structure can help you manage taxes better and keep the farm running smoothly. Tax rates on capital gains vary depending on your income and where you live. In the United States, federal rates are usually between 0 and 20%. Some states add their own taxes, which can increase the total. Recent changes in tax laws have increased some rates, making it more important to plan ahead. Certain reliefs like business asset disposal relief or agricultural property relief can lower your tax burden, but they come with specific rules and limits. In practice, using the stepped-up basis at death is often the most tax-efficient way to transfer farmland. Planning transfers to happen at the right time, such as after death or during low-income years, can help reduce taxes. Setting up estate planning tools like trusts can also help manage capital gains exposure. Working with tax professionals experienced in agricultural real estate and estate laws is a smart move to create a plan tailored to your farm's needs. In the end, understanding and managing capital gains tax is vital for farm families. Proper planning can help preserve the farm's value, ensure a smooth transfer, and keep the farm thriving for generations to come.